Everyone's favorite morning stop, Starbucks, just reported their Q4 numbers and the stock is up just under 2% so far as Wall Street digests this earnings release. The business beat on top and bottom line estimates, but this quarter really showed their weakness in their international segment with slowdowns and lockdowns, which we'll dive into the details on in just a minute. But as value investors, we have to ask ourselves if the poor performance is really just a cyclical issue or if it's structural, and how will all of that impact future performance? Well, make sure to stick around to the end of the video because we'll be talking about all that and more in today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. We'll be starting this video with an analysis of the financials, the top line, bottom line, balance sheet, cash flows, etc. And based on that information, we'll project what we think this business actually is worth and if it's a value investing opportunity for us. And if you enjoy this type of content, make sure to subscribe, like the video because we post on here regularly, and also make sure to leave your video recommendations down in the comment box below. Other than that, let's jump into the video. All right, and before we take a look at the fundamentals, let's see what the CEO said about this quarter. And that's that they saw accelerating demand for Starbucks coffee around the world in Q4 and actually throughout the year as well. And that Q4 demonstrated a return on their investment so far. They're looking to reinvent the business in order to improve customer and store experiences so that they're in the position to deliver accelerated, sustainable, long-term profitable growth. So we can see this is a business that has been able to grow the revenues year over year on a consistent basis besides our 2019-2020 slowdown. And they are of course focused on returning shareholder value. But let's take a deeper look into the segment results. We can see for this quarter, they had an 11% increase in comparable store sales. That's always a great sign to see because that means each quarter that same store is able to sell 11% more in terms of sales. That's really the number you want to see grow, especially for restaurant and retail businesses, because they can increase the store count and that is automatically going to increase the revenues. But what about the same store sales? So that's growing. But what I don't like about that is that it's not an increase in transactions. It's really an increase in their ticket prices. So they're increasing the prices by 10%. That's leading to the increase overall. Okay. Last year, the opposite was the case where they didn't change their prices all that much, but they had more volume in terms of their transactions. So this 11% increase isn't as meaningful to me, although it does indicate that people are still willing to buy at higher prices. So that's still a good thing. Of course, they did increase their store count and resulted in a $6.1 billion revenue for this quarter, up from $5.7 billion last year, a 6% increase. But take a look here. We have $1.1 billion in operating income. That's down 9% from last year, which was at $1.2 billion. But why is that? Well, they're saying that's primarily driven by an investment and growth in labor, including enhanced store partner wages, as well as increased spend on new partner training coupled with higher commodity and supply chain costs due to inflation. Okay, so store partner wages have increased along with their labor force. And when we add in inflation into that, yeah, costs are going to increase for sure. Let's look at their international segment. We actually have a decrease in change in comparable store sales of 5%. All right, and if we expand on that a little bit, we had a 5% decrease in transactions. That's bad to see. And then they also decreased prices as well. So things are getting cheaper, but they're actually having less sales as well. This is not a great sign to see, especially from a business that is really trying to improve their international segment. Last year, that strategy worked where they decreased their ticket prices and it ultimately resulted in more transactions. This year, it definitely didn't work out. And despite increasing their store count by 8% this year, revenues still were on the decline here, down to $1.7 billion for this quarter. Operating income also declined 42%. That's a huge hit there. And margins were also reduced to only 12%. But they are saying revenues were mainly impacted by foreign currency translation and COVID-19 related restrictions in China. Now, how does that impact fundamentals as a whole? Well, when we scroll down here to our statement of operations, we can see total net revenues came in at $8.4 billion for this quarter. That is up 3.3% from last year, $8.1 billion, where we can see licensed stores actually had a 25% increase. That's pretty strong. And the one thing I really like about their fundamentals as well is that they keep their costs relatively the same year over year, despite increasing stores. All right. So total operating expenses are only up to $7.3 billion from $6.7 billion last year, all the while increasing the number of stores. So naturally expenses will increase as well, but that ultimately leaves us with $1.1 billion in operating income, down 19% from 1.5, let's call it billion last year. And that's how the quarter ended. But let's take a look at this from an annual perspective. When we scroll down here, we can see total net revenues of $32 billion, up 11% from $29 billion the year prior. Total operating expenses up to $27.8 billion, an increase of 13%. But again, we had those store increases, and that ultimately trails down to our operating income here of $4.6 billion, down only 5% year over year from an annual perspective. So only a $200 million difference year over year. So not much has changed, but I think we still need to break this down just a little further to actually give us a clearer picture. So if we look at the North American fundamentals, again, revenues $23.3 billion, an increase of 14%, and it cost them $18.8 billion to produce those revenues, ultimately $4.4 billion in operating income. That's actually an increase 5.3% year over year. year. So the North American segment actually showed us growth on an annual perspective, but the international segment, now let's take a look at this. Total net revenues of $6.9 billion. That's actually flat year over year. And then after we deduct for our total operating expenses, we're only left with $833 million. That's down 33% year over year, which really goes to show what's actually impacting this business right now. It's clearly their international segment, as the North American segment is clearly growing. They're really having a big pullback, especially in China with the lockdowns and such. That being said, what is their liquidity like? Well, they have $3 billion in cash, let's call it, on the $13 billion in short-term and long-term debt. From a cash on debt perspective, that doesn't look amazing. On top of that, they also have $36 billion in liabilities, only let's call it $28 billion in total assets. And this is one of those rare occasions where liquidity actually looks pretty poor on Starbucks' part. Let's move on to the statement of cash flows though. We bring down our net income figure of $3.2 billion for the year. Add back in our non-cash cost, leaves us with $4.4 billion in cash provided from operating this business. We deduct our $1.8 billion in CapEx. That leaves us with about $2.6 billion of free cash flow to reward shareholders. What exactly did they do with it? Well, it's what every business is doing these days. They're paying out a dividend and also repurchasing shares. All right, so now when we want to put these numbers into the calculator, they came in with about $4.6 billion in operating income. We can see over the past few years, this has actually been a historical average for them in terms of operating income. So yeah, let's plug that into our calculator. And if we require a 10% return, they are currently paying a dividend. And if we estimate that on an average scenario that this business can grow for the next 5 years at about 5%, especially once we have a rebound in the economy, that drops down to about 3% for the 5 to 10 years after that. On a 23 PE like they're currently trading at, this stock should be worth about $85 per share, so exactly where they are right now. But in the very best case scenario here, let's say international segment really takes off. They can increase operating income by like 25% once we see a rebound, especially in China. There's less lockdowns, etc. We see further increases to their North American segment as well with an economic rebound. There's more people spending money, going out with their friends for coffee, etc. Let's say they can grow at, let's say, 10% for the first 5 years. That drops down to 7% for the 5 to 10 years after that. On a 25 PE, this stock would be worth about $125. So not a double, but about a 50% increase from where we are right now, plus a dividend. That'll actually be some nice shareholder returns there. And then in the very worst case scenario here, where Starbucks has further segment losses across North America and their international business, let's say they can only grow at 0% for the next 5 years and then 2% long term on a 15 PE. Yeah, this stock will only be worth about $51 per share. How likely is it that we get down to $50 per share? I mean, we've been there before, especially during the crash of 2020, but we can see what happened with the stock price as soon as that happened. Yeah, we had an immediate push up in price, up over 100%. So make sure you take that into consideration as well when you're making your analysis. That's my analysis. Please let me know what your thoughts are in the comment box down below. Are they going to continue to grow? Are they going to see a nice rebound in the stock price once we see an economic rebound? Or are we going to see some more chop from Starbucks? Again, let me know what you think. That's all for me. If you enjoyed this video, please like, subscribe, and I'll catch you on the next one.